Why do austerity measures slow economic growth? Imagine a country trying to bounce back from a financial crisis. Governments often turn to austerity measures to fix their budgets. But how do these policies affect the economy in the long run? Let's find out. Austerity measures are policies where governments cut public spending or increase taxes to reduce their budget deficits. These actions are meant to make borrowing cheaper and restore confidence among lenders. But they also change how much money is flowing in the economy. When governments cut spending, they reduce the money they put into the economy. Public sector jobs may be cut, and government-funded projects like roads or schools get delayed or canceled. This means fewer people are earning wages or buying goods and services. As a result, overall demand in the economy drops. Higher taxes also play a role. When taxes go up, households and businesses have less disposable income. People buy fewer things, and companies might hold back on investments or hiring. This further decreases demand and slows economic activity. The concept called the fiscal multiplier explains why these effects can be bigger than expected. When government spending decreases or taxes increase, the total decline in economic output can be more than the initial change. This is big, as less demand leads to lower income, which causes further reductions in spending and investment. During times when interest rates are already very low or the economy is weak, central banks cannot easily lower interest rates further. This means they cannot offset the negative impact of austerity policies. Without this monetary support, the slowdown in growth can become even more severe. In the short term, austerity often leads to higher unemployment. As government jobs are cut and demand falls, businesses see less sales and may lay off workers. Over time, reduced investment in infrastructure, education, and public services can also hurt productivity and limit future growth. While some argue austerity can help restore fiscal stability, the evidence shows that during recessions or economic slumps, these measures tend to slow down growth and increase unemployment. This happens because the economy is already weak, and cutting demand only makes things worse. Governments implement austerity to lower borrowing costs and keep financial markets stable. But the trade-off is often slower economic growth and more job losses in the short run. If the economy shrinks too much, it can make debt levels worse relative to the size of the economy. In summary, austerity measures slow economic growth mainly because they reduce demand through lower government spending and higher taxes. This leads to less production, higher unemployment, and less investment, especially when monetary policy cannot fully counteract these effects.